Hi, it's Anthony here. In this video, we're going to have a look at the market correction that we've seen with metals. We've all witnessed the incredible run in precious metals lately, reaching all-time highs. What we're seeing now is a classic sharp market correction. So if you look at this trajectory, price action hit a wall after a massive surge. Bank of America analyst Michael Hartnett has been sounding the alarm, describing the sector's status as nutty overbought, as he put it. The core thing to understand here is that this isn't about market manipulation. It's the rational unwinding of extreme leverage. So what we're going to do in this video is unpack why this is happening and where the floor might actually be. To get a clear picture, we've got to look at the signals. Silver recently showed its second largest deviation from its 200-day moving average in history. That kind of stretch is unsustainable. On top of that, a record of 45% of fund managers now view gold as overvalued, creating a hair trigger sell environment. This crash is being fueled by paper side leverage and the unwinding of leverage along with option expirations. It's not necessarily by viral rumors of JP Morgan manipulation that you might have been hearing or seeing. Expect short-term volatility, possibly a bull trap rally before the market truly flips into fear and finds a real price floor. And what I mean by that is a move possibly back up into equilibrium and quite possibly more downside. If we look back in time, history shows that every great run ends with a definitive event. We saw it with the end of the Nixon shock in '74. We had the Volcker rate shock in the 80s, 2012, and the EU debt crisis, and then, of course, 2020, we had COVID vaccine arrival. Okay, today, 2025, 2026, we've reached that same mathematical breaking point. The market acted as a hedge against dollar debasement, but the velocity of the move simply detached from reality, and it's simply unsustainable. The real danger right now is institutional crowding. Look at this record high. Net 45% of managers think we're in overvalued territory. Most of these institutional players are currently overweight in commodities. This creates a liquidity trap. If prices start to slip, their own mandates force them to sell to protect capital. It becomes a self-reinforcing downward spiral where everyone is trying to hit the exit at the same time. Now, there's a lot of noise on social media claiming JP Morgan intentionally crashed the markets by closing 633 short positions on Friday. But the reality is much more technical, in my opinion. JP Morgan acts as a dealer and a warehouse, not a speculator. The contracts everybody is pointing to actually settled back on January the 28th, well before the crash. The filing people saw was a notice of intention to deliver, where buyers took physical delivery of over 3 million ounces. This wasn't a naked short dump, it was a matched client transaction. The true driver here is the paper unwind. As futures contracts rolled over, buyers locked in prices at what turned out to be the absolute market top. When that leverage starts to unwind on the paper market, price supports just vanished. It's important to remember that as a dealer, JP Morgan is legally restricted from speculation on these assets. They just facilitated the trade while the market driven leverage collapsed. On the physical side, it's total pandemonium. The refineries are seeing panic selling, and many dealers are literally closing their doors because they don't want to take on inventory losses. And what we're seeing is a massive disconnection in the spread. The price to buy remains high to protect dealer margins, but the price they'll pay you is dropping rapidly. When the option to sell your physical metal disappears, the panic only moves faster. So we get this acceleration and panic. We're also seeing a major signal from China, the world's largest consumer market. The Industrial and Commercial Bank of China, or ICBC, issued a formal advisory telling investors to avoid impulsive trading. By discouraging retail speculation, China has effectively removed a critical layer of price support that the market was counting on. If you want to see how bubbly this got, look at the turnover momentum. Speculative froth in silver actually exceeded tech darlings like Nvidia, reaching over 11 times normal levels. As of March 2026, a staggering 95% of the open interest is pure speculation, with only 5% representing actual physical delivery. With roughly 500 million ounces in open interest, that paper demand evaporates the moment speculators head for the hills. This chart shows the mechanical loop that accelerated the drop. It started with a record call buying, which forced dealers to buy the underlying metals to hedge their risk, pushing prices even higher. But once those options expired, the price dropped below the strike price. The dealers no longer needed the hedge, and they were forced to mechanically dump the gold and silver, causing the price to crash in a feedback loop. So where are we now? We've moved past the mania and the initial crash. The thing is, though, we might see a relief rally or a bull trap, especially as margin requirements are raised. But volatility is going to stay high as the market transitions from FOMO to a desperate search for a fundamental flaw. So be careful. We are effectively waiting for that flip into fear before things truly return to normal. So how you handle this depends on your goals. If you're a macro investor looking for an inflation hedge, Bank of America actually views oil as a technically superior trade to gold right now. You might have ethical concerns about that. Tactical traders should wait for the relief rally to fade before considering short positions. And if you're a long-term holder, the best move is patience. Avoid catching a falling knife and wait for the market to stabilise. So at the end of the day, what we're witnessing is the rational unwinding of an irrational bubble. Okay, it's driven by leverage, option expiries, and technical exhaustion, not a conspiracy. Okay, the institutional consensus is that the correction possibly continue. So the most prudent approach is patience. Wait for the speculative momentum to fully break before making your next move. Now, I've been doing regular videos on what I'm calling the gold monster trade. My bias is overall bullish on the higher time frame. Okay, so just a quick look at this monster trade strategy that I've been sharing. If you go back through my YouTube videos, you'll see these. And the idea is we continue to buy gold on every rally. Bias is bullish on the higher time frame, so we keep buying. As we gain 1R, like 1-to-1 risk-reward profit on each of these trades, we take partial profits, we close 50%. So all of these trades here are already in the money. So the idea with this strategy is we make money, and we mitigate risk by closing 50% partial profits. And when we have an instance like this where we get a pullback, okay, we lose these, but these are already in the money, I guess is what I'm saying. So it doesn't matter. So we lose these trades. However, these back in here are still running. I've got a $10,000 target up in here, right? So we just keep moving our TP. And over time, okay, think of how this builds wealth if you've continued this strategy over a period of time, 2025, okay, 2026. Now we've got a new opportunity here to build our positions and buy and hold. Close 50% as this continues up. So what I'm going to be looking for here is for this to settle. We could get a bit of a relief rally and it might drop a bit further, but when this rotates bullish, I'll be doing more of the same pretty much, building my position. And if it happens to continue up, it's a bonus. If it turns around and drops lower, we lose these, but we've already closed 50% of each of these trades at 1R. All right, we always close the previous position before we open the next one. So who knows where gold is going to end up, right? Yeah, it could do that. But the idea is, well, these guys will still be running if we get another pullback. And then we just keep building this as we go. All right, so you can draw the line through here. Okay, all of these trades have been taken out. All these are still running. So these ones are still running. The pullback takes those out. Okay, it flushes out a few, but the main thing is these back in here are still running. And if you do the math, you'll find that this is an incredibly sound and potentially profitable strategy that could make a big difference. Okay, so if you haven't already, maybe go back through my YouTube videos and check out my monster trade videos as we really dig deep into this strategy. Okay, so that's my take on metals at the moment. If you haven't already, subscribe. A thumbs up would be awesome. Help me support the channel. If you've gained any value from the video, comment. What are your thoughts? Let me know what you think, and I reply to every comment. So with that, I hope you have a fantastic day. Trade safe, and I'll see you in the next one.